Welcome back to the Mining Pod. On today's show, we're joined by Parker Merritt of Coin Metrics. We go through 2023's Bitcoin mining data. This is a heavy charts and picture oriented show, so I'd encourage people to find a YouTube link to the show, which you can find below, or just watch it on your phone or on a TV projected somewhere. There's a lot of great metrics and data that Parker has presented for us here. We're also joined by Charlie and Matt to kind of go through the nuts and bolts of why these charts matter. Really great episode, and thank you to Coin Metrics and Parker Merritt for making it happen. I'd also like to encourage people to stay tuned through the holiday season for our Bitcoin mining immersion conversations, which are happening throughout the next few weeks. Thank you to Taylor and Mark for making those podcasts possible. Lastly, go check out our new newsletter, Blockspace.media. We're putting out 2 newsletters per week right now. We're going to ramp that up going to 2024. We want to make that the best newsletter in Bitcoin covering mining, Ordinals, Bitcoin tech, Bitcoin culture. So go give it a sub today. Okay, first a word from our sponsor, and then let's jump right into the show. Is your mining operation happening ready? Take control of your own future with the right energy strategy. Lincoin Energy Trading Platform is a tool used by miners to design, monitor, and seamlessly orchestrate sophisticated energy strategies within electricity markets such as ERCOT, New York, and PJM. Avoid penalties, participate in demand response programs, and capture hundreds of thousands of dollars per megawatt per year by deploying the right block and index strategy. Secure your competitive edge at lincoin.com. Are you a retail or institutional investor interested in Bitcoin mining companies? The Miner Mag brings you free data and analysis from all major NASDAQ-listed Bitcoin mining operations to know who stands out. Check out visualized metrics and data-dependent stories at theminermag.com. Welcome back to the Mining Pod. We got a New Year's roundup. Parker Merritt and Matthew Kimmel joining today. Parker's from Coin Metrics. He normally would come on like every quarter to do Bitcoin mining updates for us from the Coin Metrics data team, but we only got him at the end of the year, and that's okay because this is probably one of the best shows of the year. So Parker, welcome to the Mining Pod.
Great to be back as always, Will. Appreciate you having me.
Cool. So we'll jump right into it. For listeners, this is an hour straight of pure data distilled into beautiful charts. I would encourage you to watch this on YouTube, or if you're watching like on Spotify, throw it up on TV so you can follow along. There's some amazing information in here. We're going to do our best to keep it lively and fun as we keep going through. There will also be some stuff from the year that you've heard about. So we'll go through like ocean and different mining pools, different headlines from the year, and look at it from a data perspective. So I'm going to throw this chart or this graphic up, and then we'll hand it over to Parker to get going.
Awesome. So right off the top, always great to have an opportunity to shill my employer, Coin Metrics. So, real quick, if we just hop to the next slide, we do have a link that actually your viewers can scan to go directly to our repository of past mining research. This is a topic I really like to deep dive on. We do have a quarterly mining special that comes out at the end of every quarter, as well as a number of more in-depth reports. I think previously you may have discussed our Signal in the Nonce report, which kind of goes into some methodologies for fingerprinting ASICs on the network and kind of determining what's the hardware composition. And then we got some cool sort of fundamental breakdowns as well. So lots of great content on mining. I would just encourage your listeners to check out what we've got. So now that we got that out of the way, we can dive into the data.
Scan that QR code.
Yes,
QR
sir.
code. Also, do go subscribe to their newsletter. Top 1 in Bitcoin mining, top 1 in Bitcoin crypto.
Appreciate
it. Back to you.
Awesome. So for the next section, we're just going to kind of breeze through some fundamentals and kind of look at the state of the mining landscape here at year's end 2023. So we won't spend too much time on this stuff. Obviously, a lot of your listeners will be very familiar with some of these metrics, but first up, we've got our hash rate. Looking at hash rate over the last couple of years, obviously there's been some blips in the chart here. Obviously, the biggest being the sort of Chinese migration of hash rate, out of China and basically into the US for the most part. Since then, it's been on a tear and pretty much a straight run up, especially this year. We started the year around 250 exahash per second in terms of the 30-day average of hash rate. It's good to look at these things on sort of a moving average basis because there's a lot of volatility in this metric. But yeah, effectively, even though we've had a bit of a rough year in terms of price, at least at the front end, hash rate has continued to climb and has essentially doubled by year's end. Right now, we're sitting at 493 exahash per second. So, obviously the halving is something that's quickly approaching, and I imagine that's going to have some implications for hash rate. Also, we've got a number of new ASICs that are going to come online, the S21 class. But yeah, I guess, maybe a good spot for some color commentary here. Of course, I know you like to do hash rate predictions at the end of the show, but maybe we front load it a little bit here. So, what are we feeling, gentlemen? I'm personally of the camp that maybe it'll be a little bit lower than most people expect. I think you called 700, 750 on a previous show, Will. I'm kind of in that camp as well.
Oh, the
But yeah.
listener. I love to
hmm
hear that you're listening. I did. So I want to get Matt's opinion on this. Matt's the much more data analytics guy on the mining pod.
For
Last year was just crazy how low everyone was, like 350. Everyone, that was a bullish number, and we blew through that. I think next year I'm going to stick around 750. I think that we had a lot of facilities and ASICs to be unwound from the year before, and we saw a lot of that get deployed. And I think now we're back in the cycle of the early innings of a bull run, which means that ASICs are being deployed, like new ASICs off machine lines like T21, S21, and those units are just starting to ship. People are having a hard time getting S21s right now. I've only heard of a handful of people who've actually gotten them. So I think it's going to be a while before that's deployed. That's going to take a year. And then 2025 is where we see a surge in hash rate. Matthew?
I mean, I agree. I think, the way the typical kind of phases of a mining cycle goes, we're not quite to where there should be like a mining gold rush period where, the price really explodes and hash rate is growing, but not quite at the same pace. Because there's a lag time, right, between when there's actually the decision to, I want to be a miner, I'm an entrepreneur, I see an opportunity, and then actually bringing the hash rate online. And so I kind of agree with you, Will. I think end of this next year, 750 sounds about right. Obviously, like the data analyst in me wants to actually like run some numbers and try to figure out how how many ASICs that
That's why
would.
we have Matt on the show. Keeps us honest.
But I think 2025, you really see an explosion of hash rate, right? That's like as far as the timelines go, I think that's when it really erupts north.
Yep, I would agree. And I also think it's a factor that it seems like there's not that much old hardware on the network right now. Like I think in previous cycles, like we had a lot of ASICs that were being kind of phased out right around the time of the halving. And we'll get into hardware composition a little bit later in the show, but I do think, the majority of the hash rate deployed right now is sort of upgraded, S19 and up. So, as long as those ASICs can remain profitable, I don't see any big reason for a dip in hash rate. So yeah, definitely going to continue to climb.
Dope. Okay, let's keep moving along. Hash value and hash price. Daily revenue per terahash.
Yeah, again, another fundamental metric, as you mentioned. This is just how much miners are earning for every terahash per second deployed per day. So two different measures of this: the Bitcoin denominated version, hash value, and then hash price, the USD equivalent. 275 sats per terahash per second in hash value and around 12 cents in hash price. I mean, the main reason I include this is I always think it's interesting kind of looking at the divergence between, basically how a miner is doing their accounting, whether they're optimizing for USD gains or BTC gains. We've obviously had a pretty big uptick in hash price, uh, basically back to, yearly highs, thanks to the current ongoing Ordinals boom. But we haven't reached the, sort of yearly high in terms of hash value. It was basically much higher earlier this year with the BRC20 boom. So even though miners are experiencing some USD sort of gains thanks to the increase in hash price, I think this kind of does highlight that, lost opportunity in terms of Bitcoin denominated gains are fleeting, and sometimes there's not an opportunity to get that back. So
Cool. Quarterly BTC miner revenue versus hash rate. This one's an interesting one given what's happening with ordinals and fees right now that Bitcoin miners were not expecting one, Bitcoin price to be up, and two, fees to be so high. I think a lot of people expected like max pain right now. And I certainly thought like going into the halving, it was just going to be awful, but it's pretty juicy out there at the moment.
Yeah, it really just depends on, how sustainable this trend is. And, again, we've kind of seen this ordinals thing not really be a flash in the pan like a lot of people expected. It's made a comeback basically every quarter in different forms and fashions, first inscriptions, then sort of tokens, and now kind of a mix of the two. But yeah, this is another one of those charts that, I prepared a couple days ago. And every time I hit refresh, fees are another 20, 30, 40 million higher. So, I'm sure, even by the time we finish this podcast, the fees will probably have broken 400 million. But as it currently stands, Q4 total mining reward is around 2.67 billion. And then the component of that is transaction fees is 381 million, which is the highest it's been since basically the height of the bull run in 2021. So, certainly interesting to see these kind of mining revenue figures when we're not even at an all-time high. And, just to kind of underscore that once again, this chart here just basically shows BTC price versus the median transaction fee. Right now, median transaction fee is sitting around $25 to broadcast a transaction on the Bitcoin network. And you can see very clear correlation in past instances where this metric is spiked, almost always associated with a new all-time high in Bitcoin price. But here, that is not the case. We're seeing a big uptick in transaction fees, even though we're only sitting around 42, 43K. So yeah, it'll be very interesting to see where these numbers line up once we actually do hit another all-time high. So this kind of, diverts a little bit and goes into more of sort of the underlying, components of that transaction fee revenue. One interesting thing is you didn't see in past sort of ordinals inscription booms this metric, which is basically the number of op return outputs. And, maybe you guys can share a little bit of extra color on, op return and its history, but basically it's a way of embedding arbitrary data in the blockchain and has been used in the past by protocols like Counterparty to do things like NFTs and tokens, such as famously Rare Pepes. So it seems like a number of new ordinal type protocols are taking advantage of op return and kind of, being a little bit more efficient with block space. And so just recently on December 14th, we saw op return outputs hit not an all-time high, but the second highest ever, 187,000. It only peaked around that high in mid 2019. So kind of an interesting, next step in the evolution of ordinals is taking advantage of this old opcode op return.
I feel like this is Matt's moment to shine, but he's deferring to me. He's the op return master. He wrote an awesome article, research paper, honestly, at CoinShares about
I
this.
just think Parker covered it great. I mean, that's really it. It's an arbitrary field and transactions about 80 bytes large. Here's I guess what I'll add. Inscriptions using op return, I think a lot of people in the Bitcoin community who are upset about the resource usage of inscriptions should be really celebrating, because op return outputs are prunable from the UTXO set. And so the more usage of op return, the less kind of memory resource intensive burden there is on nodes, right? Whereas if they do kind of other types of things like the bare multisig type of outputs, that stays within the UTXO set, and that does have relatively more of a burden on nodes. And so, this is a potentially positive thing, I think, for the camp of Bitcoiners that aren't championing ordinals and are kind of like want to encourage node running.
Yeah, one other thing about this, I was on the Blockchair website the other day, and interesting chart that I saw was the size of Bitcoin transaction and then how much it's just been going up over this last year as people have been putting in arbitrary data, and filling out op return is one way of doing that, and then the segue discount spot is another way. So that's an interesting thing to keep an eye on. This is like sort of sidebar zigzag on you guys, but the reason for not allowing arbitrary data in a Bitcoin block, or limiting it at the very least, has to do with keeping the node size small, right? So we can have like more decentralization. Interestingly, though, like the cost of storage just continues to decrease over time. So it feels like this is less of an argument over time. And the market is also more interested in storing things on Bitcoin because maybe that scarcity, or because it's fun, who knows? So throw it out there.
One thing on that, the blockchain size is designed to pump forever, right? As we add blocks. The reason for block size limits is basically because also the cost of storage is designed to opposite, not pump forever, right? Go down. And it's the balance of those things that is supposed to encourage decentralization of the network, right? And it's just found that the limit that we're at is possible or enough to encourage enough nodes long term.
Definitely. Okay, we'll keep moving along. We took over right there. Sorry, Parker.
No, that's perfect, and incidentally teed it up perfectly for this chart, which is actually the total Bitcoin blockchain size. So essentially, like you guys said, that's really the reason that people are sort of up in arms about this Ordinals and inscriptions activity, is it bloating the blockchain size and making it more difficult to run a full node. And so you can kind of see over time, we have seen a significant spike in terms of the average megabytes added to the blockchain daily. Right now, it's hovering around 247 megabytes. And so as a result, obviously, the blockchain size has grown pretty substantially over the last year. Currently, we're sitting around 534. And I don't think that necessarily fully captures the amount of space required to run the node. Obviously, there's a little bit of extra resources needed to remain in sync with the rest of the network. But I do think it's kind of interesting that we saw a pretty huge spike in terms of the average megabytes added daily. But since then, it's kind of leveled out, and it's not quite as high as it was. And, I think the important thing to remember is, like, these inscribers are also very cost sensitive. They're market participants just like everybody else. And they are coming up with more efficient ways to add this metadata to the blockchain that's prunable and embedded a little bit more smartly. So, I do think kind of the average megabytes added daily, we're seeing kind of, level out in response to those market conditions.
This is a cool chart. I wish Luke Dasher was on the stream right now. We could ask him about it. I wonder how he would feel.
Shoot him a DM.
We're adding more data, but it's all valid transactions. How can anyone be upset with that?
It's true.
Back to you, Parker.
Awesome. So yeah, we've covered basically all the fundamentals that are sort of, covering the landscape of the mining ecosystem so far in 2023. But one big area that a lot of people have been paying attention to is the mining pool landscape. Mining pools have, typically been kind of silent facilitators in the background, but we're starting to see a lot more centralization, and as a result, they're actually impacting the activity on the network. So if we hop to the next slide, we can kind of see the relative dominance of mining pools over the last 2 years. Starting in January 2022, we saw that the top 4 mining pools, Foundry, Antpool, Via BTC, and F2 Pool, made up collectively, less than 60% of the network. And they certainly hadn't breached that 51% threshold that everybody kind of pays attention to. But at the top of this year, we basically did breach that threshold. And on a 30-day moving average, Antpool and Foundry have, for the entirety of the year, controlled more than 50% of the network. And we've seen it kind of flip back and forth between the two. Essentially, they're neck and neck right now. Obviously Foundry, US based, everybody's kind of KYC'd, institutional miners, and then Antpool, obviously very close knit with Bitmain, who manufactures ASICs. So some major points of centralization for both of those pools. So yeah, not the prettiest sight if you're a decentralization maxi, I will say.
One thing I want to add on to this is that Ampul's actually dominance on the network might be larger, and people aren't paying attention to it because Ampul isn't necessarily signing the blocks, but a lot of people do divert hash rate through Ampul. So this is like information that's like kind of conjectured out there. We don't have confirmation on it, but it does look like Brains might be using Antpool to white label for the interim until they get their FPPS pool off the ground again. Again, that's not published by them, but it's just kind of like rumored out there. And I did ask for them for confirmation about it and did not get confirmation. But
Spicy.
it is a thing.
That's so nonchalant. That is a spicy drop on the mining pod right
there. It is a spicy drop. But I think like they're going to move away from that. They're trying to get their FPPS pool off the ground. I don't think it's that big of a deal. I think what is a bigger deal is Ant Pool's dominance is probably larger than we think if you look at some of the other pools that might be whitelisting through it as well. So pay attention to that, I think, going into 2024, especially with the advent of MEV on top of Bitcoin, where Bitcoin miners are going to be looking for rare sats. They're going to be going through these ordinal auctions and moving transactions around in different places. So that dominance is going to matter more and more, even if they're not going to attack the network. They are going to play games with transaction ordering.
Yeah, and I've certainly heard those rumors as well. I've even heard some people say that Ant Pool essentially controls more than 50% of the network through these proxy pools. And, we're certainly looking for ways to kind of prove that on chain. Not as relevant now, but, I think in a previous mining special sort of podcast, we did actually uncover a Coinbase output mined by Poolin that was sent directly to Ant Pool. So, Poolin obviously had a lot of liquidity issues back in, I want to say late 2022, and it appears as if Ant Pool maybe bailed them out. So you can definitely think of Poolin probably as one of those proxy pools. But yeah, definitely interested in kind of digging into the on-chain data and see if there's any other evidence to link together Ant Pool and some of these other pools.
Yeah, one other thought on it. It's just interesting that Ant Pool is like the pool that people go to for that. I guess it's probably because it's almost an insurance policy. Ant Pool is going to land blocks. You don't have to worry about the luck there. They're going to pay out. Another part, of course, is the relationship with Bitmain, but you would think some of these other pools might go with Foundry. It probably has to do a lot with the KYC. If you do Foundry, you have the KYC, and someone like a Brains or another smaller pool doesn't want to have to KYC their hash rate, so they're not going to do that. Foundry still ticking along, and if we have another explosion in North American hash rate, it's definitely going to go up again over 2024.
Absolutely. And, there are definitely some implications for transaction settlement on this pool dominance as well. One chart I like to revisit is the percentage of blocks that are empty mined by each pool. So this is, kind of a way for pools to flex that they're very operationally efficient in terms of selecting transactions for their template. For the longest time, Foundry and Marathon have kind of bragged that they mine no empty blocks. Whereas some of their competitors, like Ant Pool, for instance, actually have a relatively high incidence rate in terms of empty blocks. And, you can kind of see on the side here, this has become a little bit of a topic of debate as well. Luke Dash Jr. basically speculating why it might be the case that Ant Pool mines so many empty blocks. Perhaps they're using, covert ASIC boost, which, is not necessarily compatible with SegWit. And, I think it's also interesting, perhaps, if you kind of link together where some of these empty blocks are being mined, maybe that is indicative of a relationship with Ant Pool. Not to call anyone out, but Luxor, last year they had no empty blocks. This year they've actually had a relatively high amount. So, again, always interesting to kind of look at this metric and see who's most operationally efficient.
Maybe that's why Charlie didn't jump on the podcast today. He was dodging this moment.
Shots fired.
Didn't want to put him on the spot, but, not here to defend himself now. So
interesting. Yeah, the empty block stuff has also been of note for Ant Pool. I was at PubKey last week doing a mining pod with Thomas and Drew there. And then during a presentation later, we had a Q&A, and someone in the back started yelling about Ant Pool. They're like, they've had 5 empty blocks in a row. And didn't really have a good reason for why that was happening. 5 in a row seems kind of odd. Parker, did you have any thoughts on that recent trend?
I mean, not really. Like, I don't think it's necessarily malicious, especially, in this period of time where transaction fees are so high. There's obviously a cost imposed on Ant Pool by doing that. I think, it could very well be this covert ASIC boost thing that Luke is alluding to. Another thing I'll add is, like, supposedly Stratum v2 will mitigate this issue because miners will be able to select their own transactions. And so there won't be kind of that latency between the pool distributing the block template and the miners beginning to work on it. So hopefully that's something we're going to see trend down over time as more pools adopt Stratum v2. But then again, not sure if there really is a strong incentive to adopt Stratum v2, because a lot of pools do get some advantages out of being able to select transactions. So, but yeah, I would say probably the most credible theory so far is what Luke is saying here, but definitely,
Okay.
open to other narratives.
I apologize. I broke my own rule and asked for clarification on your earlier point, but thought I'd
All
follow
good.
it up with an anecdote there. Okay. Still more slides on pools here.
Yeah, I think this is the last one in this section, in terms of the broad pool landscape. But, early on in this analysis, basically just wanted to take a look and see if there is any credibility to Luke's theory, actually. As I mentioned, Coin Metrics and Kareem Helmy, in conjunction with us, have developed a methodology for fingerprinting, essentially the nonce in the blocks that are mined on the hash rate, in terms of the network wide coverage of ASIC composition. So we are actually able to also slice and dice this at the pool level and get a view into what kind of rigs are running between Foundry and Antpool. We can see actually that Antpool's hash rate has a higher composition of S19 XPs. I think, being again linked to Bitmain does give them some advantages in terms of the supply chain, being able to procure more efficient ASICs. And there are a number of older machines that are running on Antpool as well. A very small amount of S9s are still contributing hash rate. A good number of S17s as well, which you don't really see on the Foundry side. And then surprisingly, you do see some M20Ss as well, which, obviously is a What's Miner model, but there is some presence of that on Antpool. So there are a few different rigs that are a little bit more prevalent on the Antpool side that are older models. So, perhaps that can be linked to the incidence of Antpool's empty blocks as well. But yeah, just thought I'd highlight this as kind of a developing area in terms of fingerprinting pool level hash rate.
This too adds some credence to the theory that some of Antpool's rise in hash rate share could be due to Bitmain self-mining some of their sideline inventory that has not shipped yet to miners, right? If you look at the share of the newest generation XPs here, would be interesting now to see the even newer models that have been released, right? But the differential here could mean that, and we know the relationship between Antpool and Bitmain is so tight, right, that it could make sense. This is an interesting chart.
Even anecdotally, we're seeing this as well. At least I'm seeing this from people who are deploying XPs on behalf of Bitmain, and a lot of these XP orders are just being shipped to the US where there's open spots. One other thing here, little S9 wick coming up at the end, which is nice. Maybe our S9 Garage Warriors are back on the market here soon. I saw some people talking about at like 2 cent power they're profitable, so that'd be kind of fun to see pump again on eBay.
Mm-hmm.
I hope so. The Venerable Warrior.
AK-47 of mining.
AK-47. Yes, sir. Love that. So yeah, we've kind of covered the pool landscape at a high level, but one of the most controversial pools this year has been F2 Pool. They rank somewhere between third and fourth, depending on the day. And this is a little bit dated now, but I think it is very indicative of, kind of the power structure of these pools. A little while back, I want to say, mid-September, Paxos basically fat-fingered a Bitcoin transaction and accidentally included a 20 BTC fee. And you can see just how, huge that is in terms of being an outlier relative to even some of the larger transactions, which, generally pay less than 0.1 BTC, if not far lower. So, in terms of determining what to do with that transaction fee, Chun Wang, who's actually the F2 Pool founder and operator, took a poll on X or Twitter, depending on your preference, and basically said, what should I do with this? And the majority of people voted to distribute it to miners, but that's actually not what happened. So I do think that is indicative of who actually controls these pools. And F2 Pool has not lost a lot of hash rate in the time since.
Welcome, Charlie, to the show. We were just ragging on Luxor, and it's what was it, Parker? It wasn't filling these blocks in 2023.
Yeah, used to be no empty blocks. What happened, Charlie? You're on
Oh,
mute.
he hasn't set up his mic yet. Womp womp.
We've been focusing too much on ordinals. No, well, more full blocks. So we've certainly filled a couple blocks to the brim,
Mm-hmm.
at least.
Mm-hmm. That's true. That's true. The 4 meggers, and I figured that could be related to that. So, but yeah, that is a pretty interesting trend.
Well, don't let me stop you. I showed up late to class, but okay, right into it. The OFAC transaction.
Yeah, we saved the good stuff for you. So we just went through F2 pool. Definitely spicy, but Parker, take us away on this OFAC stuff.
Yeah, we got quite a bit more F2 pool content lined up here. So, again, most listeners will probably be familiar with this controversy, but late November, 0xB10C, who is a renowned Bitcoin analyst and developer, actually flagged a number of OFAC sanctioned transactions that were removed from F2 pool blocks. Essentially, if you take a look at when those transactions first entered the mempool and the associated fee, you would suspect they would be included, if you're purely going on economic factors, but they were purposefully excluded by F2 Pool, and actually Chen Wang, again, took to X to basically justify the censorship and basically said that he didn't want to facilitate transactions for terrorists and dictators. And since then, he kind of reversed course and said, all right, we won't necessarily filter blocks for now. We'll see what the community, decides, which I think the community has decided that censorship is not a pro. But this is kind of just an illustration that clearly these transactions should have been included if you're purely going on transaction fees. And I think, the pressure is only going to get more intense from here. Senator Warren does have a bill that basically would hold miners liable for facilitating OFAC transactions, to my understanding. So I think we need to keep mining pools honest in terms of, what's going into the block templating.
This is such an interesting story, and we're seeing it in the Ethereum stuff as well, where Blockspace this week or last week announced that they're going to start filtering as well. The difference, of course, with the Ethereum ecosystem is there's a lot of centralization and block production along like the different stopping routes because it's so new. Only a few teams are sophisticated enough to do it as of now. Bitcoin mining has been around for quite a bit longer, so you don't have to give into this censorship, but they obviously got a little spooked, so they give into it for now. I think long-term Ethereum kind of figures out its problems around this, but it is interesting to see the two ecosystems. One has to give into it and the other is optional.
I think one thing to note on this too, all of those transactions were mined by another pool, right?
Yeah.
Censoring is really just a cell phone, as long as the fees are economical on the censored transactions. So I think it really only becomes an issue if it's consensus-wide, all the mining pools are deciding to censor and those transactions are actually not being included. And then that poses an opportunity for a new entrant, right, in competition. Yep. The Warren stuff, I think, doesn't really become very interesting unless they start to say, you can't mine on the same chain as these transactions getting, right? Because then it becomes a controversy of a chain split, which is we could do a whole podcast on another day, and it won't sidetrack. But
don't tempt us.
I don't think that this is any kind of Bitcoin problem.
Yeah, one last thing here on this as well is, I do think the comparison to Ethereum is pretty notable because I don't think the volume of OFAC transactions on Bitcoin is honestly all that high, but having sanctioned Tornado Cash on Ethereum, that's a very sort of centralized entity that a lot of transaction volume is flowing through. So I think, Bitcoin has managed to avoid at least the perception of this problem just because the volume isn't very high. But as, sanctioning perhaps becomes, more prevalent and, a relevant political topic, it may become a bigger issue. So. Cool. So, kind of another form of maybe soft censorship is mining pools, as I mentioned, do have the advantage of creating their own block templates. And as a result, with F2 Pool in particular, we actually see them mining quite a few zero-fee transactions, which, of course, are not really what you would think as economically optimal. Around 100,000 V-bytes per day are mined by F2 Pool with zero-fee transactions. That's approximately 10% of the capacity of the block space that they're mining. And that hasn't been a huge issue for them. But recently, as transaction fees have kind of ticked up, there becomes a real economic opportunity cost in terms of mining zero fee transactions. To date, basically, they've surrendered 300,000 in transaction fees by mining these transactions. And that's for the second half in 2023. So obviously, as the Ordinals activity continues to tick up, there's going to be higher and higher costs for mining zero fee transactions. And we do have a little bit more detail on, the nature of these transactions in this next chart. And some of this stuff actually does make a lot of sense. A good chunk of the very large zero fee transactions are just payouts from F2 Pool, essentially, paying their miners for their work. And, why would you pay a transaction fee if you're the one mining the block? That makes total sense. Obviously, there's still an opportunity cost imposed there. And so they might want to get a little bit more efficient with how they're handling that. Perhaps, taking some of that off chain through things like Lightning or side chains or whatever else might be a good approach for that. But a number of these other transactions, including that lower band of blue transactions that you see, are not necessarily what you would expect from a mining pool. These are stacks block commits. And so on the next slide, kind of go into detail on what's happening there. Essentially, Blockworks research actually surfaced this, as well as members of the stacks community. F2 Pool will essentially prioritize their own stacks proof of transfer transactions to get the block reward for the stacks sidechain, blockchain, whatever you want to call it. It's another blockchain that issues rewards to miners based on these specialized transactions called proof of transfer. And so what F2 Pool is doing is essentially censoring all other transactors who are attempting to get rewards on the Stacks blockchain and monopolizing those transactions for themselves, only including their own transactions. And as you can see here, they've actually gotten quite a bit of revenue this way. If you just go based on those zero fee transactions where F2 Pool is the sole winner, to date, this half, they've gotten around 800,000 in Stacks revenue. So it's pretty substantial.
Nice. That's 4 developers you can hire right there. It's pretty good stuff. Okay. Need a drum roll for this one. A little Ocean Pool time. I think we've done 4 or 5 shows on Ocean Pool at this point with many different perspectives, from people who invested in it all the way to people who are Twitter fighting with them. So I'm looking forward to this data-driven approach in a second here.
Sure. Always open to the spicy takes. And as you mentioned, this has been covered pretty at length. So, we can bring any of those previous discussions back into this conversation. I think, 2 things that are kind of interesting for me are just the history of Ocean Pool. Prior to becoming Ocean Pool, Luke Dash Jr. basically operated this pool called Eligus. I believe that's how you pronounce it. And this was a pretty dominant mining pool back in the day. There was a period in 2014 where they briefly mined around 25% of all blocks on the Bitcoin blockchain. And so, this pool does have a pretty deep history. It's not brand new. It's one of the oldest mining pools around. I was trying to figure out what happened in 2014 to cause their dominance to fall off. And I don't have a definitive conclusion yet, but I did see that there were some block withholding attacks. Basically, miners were submitting invalid shares, claiming they were doing work for Eligus, but they actually weren't. And as a result, Eligus was issuing rewards to miners who weren't really contributing to their hash rate. So thought that was kind of interesting. Shows that, there's a lot of kind of surface area for attacking these mining pools in ways that you might not expect. And not all pool operators in the past have been as effective as they might be today. So it's interesting to see a pool that was subjected to an attack that cost them 300 BTC to come back into the landscape.
What's up with the 1 block in 2018 there? Into 2017?
Yeah, I can't explain that. That's pretty odd.
It's just floating out there. Solo miner.
Cool. So last thing, everybody kind of knows about all the controversy around censorship with Ocean. Obviously, there's been some issues with their limits on op return, which have been blocking Samurai's coin joins. You had that previous episode on that, which was awesome. And then obviously, Luke is very upfront about his distaste for ordinals and filtering out what he calls spam. But, a lot of people say it doesn't matter. They're doing great things for sort of transparency and also the non-custodial nature of their payouts. And I do think that is a pretty interesting aspect of this pool. you can see the comparison here in terms of how the block rewards flow for other mining pools, such as F2 Pool. Essentially, they mine the block, they deposit it into an account, and then they move it to another account, and then they figure out what they owe their miners and pay it out. And miners have to do a lot of reconciliation and basically say, am I actually getting paid out what this pool has earned? So, kind of going from 0 hop to 1 hop to 2 hops, there's not a lot of transparency in terms of how that hash rate is being allocated. Ocean does seem to be trying to switch up that model and pay out directly from the Coinbase transaction. You can see here one of the first blocks they mined actually had around 17 miner payout addresses. But, some folks have pointed out on Twitter that, Ocean Pool says they have hundreds of contributors, not just 17. And so that basically means that there's probably a lot of miners who aren't receiving this very direct payout because on-chain fees are high, and, there's some optimization to be done in terms of when you're receiving a payout. So, I think, again, this kind of goes to the point that mining pools have to think really hard about how they're going to sort of directly issue the rewards to miners in an environment where on-chain fees are so high, and, Ocean Pool might not be quite as non-custodial as they claim. Cool. Last section here, or maybe second to last section, I believe, is our hardware analysis. Essentially, this goes back into our nonce analysis methodology for fingerprinting hardware composition on the network. You guys can check out our dashboard, which has live data at labs.coinmetrics.io. But essentially, again, what we're doing is looking at the nonce in each block, and because each ASIC leaves a distinctive fingerprint, we can kind of probabilistically determine which ASIC is most likely to have mined that block. And so, we've seen an interesting trend actually over the last month or so as Bitcoin price and transaction fees have increased. It seems like the dominant trend is essentially a lot of older, inefficient hardware is coming back online. A larger percentage of the network hash rate, for example, is now coming from S9s, very marginal, but ticking up from 1.7 to 2.3. Some of those are coming back online. S19s, your vanilla S19s with around 90 terahash per second, also making up a larger and larger segment of the network hash rate. And so, that's another reason that hash rate continues to grow, is actually we're seeing a lot of older hardware come back online. So this is another interesting one to kind of monitor, especially as there are more and more concerns about how efficient the network is energy-wise.
I'm excited to see some other units come on here. I wonder, well, this won't be able to work with the current analysis right now because this is fingerprinted for mostly MicroBT and Bitmain and maybe one other provider. Was it Avalon also, or Canaan is available on this fingerprint?
Yeah, I believe so. And actually, that is a really good call out. One of the shortcomings of this methodology is we actually do need nonce data to train on. So until we get our hands on some of the newer hardware and fingerprint it for a pattern, it's basically going to show up in one of these other segments. So an increase in, S21 hash rate might be interpreted as S19 or S19J Pro. So it really is important to kind of have a backwards looking view in terms of fingerprinting these things as well.
Well, if you have an S21, please contact
Yeah.
our friends at Coin Metrics.
Mm-hmm.
This is one of my favorite charts. I remember the first time you guys did this, 2 years ago, I thought was a seminal piece in mining analysis. This past summer when you did it again, I thought this is my favorite type.
You did it again.
Yeah. Well, I mean, because I look at this as an operator myself, because I want to know where I stack up as far as like operating cost of producing a Bitcoin. And this helps me like identify where the other market is, because we can throw out numbers all day, we can evaluate, we can look at public miners. But this is actually a little bit of an indicator to like real cost of production, because like look at that S9 blip. Like we know exactly where that margin is for the S9. So we can identify like, at least this percentage of network has this power cost, or is this additional capacity. And then if we you can even just take your median assumption for power costs and overlay it against different ASIC efficiencies and be like, okay, well, we can know that, given this simple, dumb, metric of saying, where the industry efficiencies lie, we can confidently say we're above or below that by X percent. I love that because it just allows some like defensible projection going forwards. There's a lot of miners. The game isn't necessarily to have this cost of production; it's to have this cost of production under your competitors. And yeah, this is my favorite. This is my favorite data.
Appreciate that. Yeah. Again, big shout out to Kareem Helmy for pioneering that work, both the first iteration and this most recent iteration. And of course, prior to those estimates that he created, our only way of really determining this was looking at how many ASICs were being produced by the manufacturers, but being able to fingerprint it at the network level with provable on-chain evidence is really a leap forward. So, and actually, to your point, Charlie, one of the main metrics that I think is interesting that can be derived from this hardware composition is actually determining what is the average network efficiency based on all the models that are online today. And so you can see that trending down over time, less and less joules per terahash, machines on average becoming a lot more efficient. And I do think it is kind of interesting. It's leveled out here recently, again, because some of these older rigs are starting to come back online. So, basically, as a benchmark, you don't necessarily have to be as efficient to compete because, Bitcoin price is going up and transaction fees are pumping. And an interesting thing that we kind of overlaid here was actually where different public miners stand in terms of their average fleet efficiency. Not every publicly traded miner will disclose these numbers. Most of the time, they'll just release a press release and say, hey, we bought a bunch of S21s. Here's the joules per terahash for that. But to really understand where these pubcos are sitting, in real time today is basically by them self-doxing their efficiency numbers. But there are a few miners that do that, and it's becoming an increasing trend, especially with this new benchmark produced by Coin Metrics. Actually, recently, Riot Platforms did cite this to show that they were kind of below that threshold. So I think this will be a really important benchmark for miners, especially in the publicly traded space going forward. And it's great to have something that you can kind of, objectively compare yourself against.
Yeah, to your point here, we had JP Morgan on the show a few months ago, Reggie Smith of JP Morgan, not JP Morgan himself. And they're talking about how this is an important metric that they're including into their notes to clients now. I think a huge knock on analysis in the past has been these miners or people investing in miners don't display information on efficiency, but they're moving forward and talking about this much more so than they did in the past as these numbers collapse in on themselves.
Absolutely. Yeah, it's really exciting to see some of that stuff cited in the, analyst space. And, with the backdrop of kind of the public mining space in mind, we did put together a number of other metrics related to the performance of those public miners with our partners at FactSet, looking strictly at, the equity space. So next slide, you'll actually see the performance of some of these publicly traded companies. First slide is Cantor Fitzgerald paying attention to the mining space. As you mentioned, JP Morgan, Cantor Fitzgerald, a lot of these TradFi companies are starting to pay a lot more attention to the mining space, especially because there are a lot of hard numbers to look at on chain. So you can see here, for example, in the Cantor Fitzgerald report, they're doing analysis of a number of publicly traded miners, calling out CleanSpark as one of the most efficient. And actually, on the efficiency chart, you could see that they've sort of accelerated their efficiency gains, buying XPs at exactly the right time. So they are definitely a leader in this space. But yeah, just kind of wanted to call out that, equity analysts are starting to pay a lot more attention to Bitcoin mining. And so all of these metrics that we've discussed today are going to become a lot more important for TradFi. But yeah, as I mentioned, this slide here, essentially, it's a little bit outdated already, again, because everything moves so quickly in this space. But as of December 6th, you can see that basically, if you were to pick between investing in publicly traded miners versus Bitcoin at the beginning of this year, Bitcoin returned around 150, 160%. But publicly traded miners actually returned around 350%. Core Scientific is a notable outlier there, mostly because they went through the bankruptcy process. So, they kind of hit rock bottom. So obviously any return from there is going to look pretty good. But on average, you can see that publicly traded miners have outperformed Bitcoin. So I think that's going to bring a lot of attention to that space as well.
That core chart's crazy. And I also loved how you said that Bitcoin only did 160% or whatever.
Right.
we're
greedy in mining.
Yeah. I mean, it's like, what did NVIDIA do over the last 2-3 years? It's 1 year, Bitcoin's just been crazy. And these mining stocks have been insane. And you're really seeing these communities of mining stock enthusiasts come back alive. There's obviously like a huge coalition of them in 2020 and 2021 as like these listings went through and these IPOs happened. And now a lot of these companies have been around for a while, and we're seeing a maturation in it, and there's more competition on the metrics. Because at the end of the day, all these companies are just selling a commodity, and who can sell it at the best price, the most efficiently. So that's something I'm looking forward to this next year, is seeing how some of these mining stocks differentiate themselves from one another, and if we see that reflective in any of the share price.
Absolutely. Yeah. Anecdotally, I will say that's one of the best ways to get engagement on a mining report is throw a few tickers in there. We've had good reception to past mining reports, but if you give somebody the opportunity to show their bags of public mining stocks, that'll definitely amplify the signal. Yeah. So last one here, I believe, is, obviously just looking at returns isn't really indicative of who's dominating the space. As I mentioned, Core has had pretty good returns this year, but relative to some of the other publicly traded miners, still very small market cap. Of course, when they went public, early 2022, that was, when Bitcoin was still pretty high and they were ramping up their hash rate. So it was well received at the time, and they made up nearly 20% of the total market capitalization in terms of the entire mining space. But obviously, they've had some troubles, filed for bankruptcy. Argo blockchain, also another one that had trouble, didn't quite file for bankruptcy, I think, but essentially were bailed out by Galaxy. So, in 2022, you saw a lot more diversification in terms of the miners that made up the total space in terms of market cap. But, Riot and Marathon have done a really impressive job kind of keeping a foothold around 50% of the total market cap. I think part of that is, they've been around for a long enough to, get allocated to all these Bitcoin mining ETFs, for example. So they have access to those capital flows. But it is interesting for all the noise that's made around other miners. Marathon and Riot are still overwhelmingly dominant.
Yeah, it'd be cool to see this versus a hash rate chart, which maybe is the next one. But yeah, the market caps are not often very reflective of overall hash rate and or efficiency of fleets. That being said, not a knock on Riot or Marathon, which both have had pretty tremendous years from their respective teams. Riot with its Corsicana upgrades, and Marathon with its huge announcement this week that they are purchasing some sites in Texas and fully integrating across not just an asset light strategy, but into facilities. So
Yeah, absolutely. Yeah. And go ahead.
Oh, it's just also interesting because, like, yeah, you can look at the market cap, and I'm sure I'm preaching to the choir here, but even Marathon and Riot, very different businesses. One is more of a hosted model, one is more full stack and infrastructure, and really the demand response. So energy market. So yeah, it's just interesting to see, like, yeah, you need like 5 charts to tell the tale of the current Bitcoin mining public miner landscape.
yeah, last thing I'm going to interject. Sorry, one more time. Some of these other miners, in terms of like efficiency and exahash online, are larger, but it's not reflective in market cap still. So Iris, CleanSpark, Hut, and I think maybe the last one I put in there. I guess Bitdeer also has a lot of hash rate online. All these different miners have so much hash rate, but like you just don't see in their market cap. So there's still like a lot of discovery, I think, for public mining stock investors.
Agreed. And last thing I'll say is, in that chart, I don't think it's a coincidence that Riot and Marathon are also some of the leaders in terms of efficiency, as well as CleanSpark, which ranks about third in market cap now. They've definitely been climbing the ranks. So, whether that's the chicken or the egg, maybe they just have the access to capital so they can kind of improve their fleet efficiency more quickly. But I think it does underscore the importance of that metric. It's important to kind of keep your hardware up to date. So
Definitely. Cool. Well, Parker, thank you for joining the mining pod. Let's open it up for a few minutes here for any like general reflections, Q&A. And if you are listening to this, drop some questions below on the YouTube chat, and we can have Parker go through later, or myself go through later, and get some answers. The feedback's great. You can also email us, William@Blockspace.media. We can get back to you with any questions you guys have about this. But any reflections on this, Matt or Charlie, Parker?
I think one, thank you, Parker. It was like a master class in chart making. I think very indicative of Coin Metrics data services. I think It's like this is a year-end thing moving forward, right? I would love to see more equity analysts taking thoughtful look into the public listed miners, really understanding how miners compete with one another, because it really is a unique market, right? I think in the previous cycle, right, bull run, bear market, I think public listed miners were very much so um, valued in interesting ways, is a way to put it, right? But probably not appropriately, right? And I think having public information on the efficiency of the hardware fleet, to Charlie's point, letting you build kind of a cost curve of miners is helpful, right? And you take into account treasury management strategies. You take into account when are they buying their ASICs and what is their potential ROI break even. Things like this, I think, will be really helpful moving forward to kind of actually try to fairly value these companies. I really liked the deep dive into F2. Um, we're very aware that mining pools do all sorts of kind of UTXO consolidations and different kind of internal transactions, and they pay out in different ways. But to just sort of see how 10% sometimes of a block that they mined are kind of their own types of transactions. I was very interesting to see and kind of see it broken down. Was really neat. And yeah, I just think in general it was a great data deep dive and a full 360 on the mining space. So, cheers. Thanks, Parker.
I missed your. I had missed that tweet from Callie, or however you say his name, on the ocean pool topic, which I thought was an interesting thing for you to include in there on uh, mining pools like Ocean, perhaps paying out from an eCash in an eCash model. I'd never considered that because, like, isn't like the what's like part of the selling point for Ocean is like, well, we're gonna do Lightning payouts, but like even our CEO Nick at Luxor has been like, it's hard to manage. There's not like a lot of demand from this really, and it's also like it's pretty much a monodirectional payout scheme, which is not really the optimal structure for a Lightning channel. So, but an eCash, like a federated eCash system, might actually make more sense. That was pretty. I'm going to be thinking about that a little bit more now.
Cool. Parker, thanks for joining the Mining Pod. Charlie, Matt, thank you also for jumping in with us. If you enjoyed this, give us a subscribe or a like on the YouTube channel, and then keep following along with us on your podcast player of choice. Also, go give us a new sub at Blockspace.media. It's our newsletter. We'll be including this into that newsletter when it comes out. And lastly, big shout out to our data provider for this show, Coin Metrics. Go to their website, use their data, subscribe to their newsletter, stay the network. It is arguably my favorite, definitely my favorite, arguably the best newsletter in crypto for data. So check them out. Parker, thanks again.
Thanks so much for having me.